Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. Starbucks just isn't a coffee shop. It's a global brand that shaped how we consume coffee, but is it still a smart investment in 2025? In this video, we're diving deep into Starbucks financials, growth strategy, and future potential to find out whether this iconic company still deserves a spot in your portfolio. Let's brew up some insights. Starbucks Corporation is a global coffee company and coffee house chain based in the United States. It operates and licenses thousands of coffee shops. Starbucks is known for its premium coffee experience, store ambience, and customer loyalty programs. It also sells products through grocery stores and online channels. Although they started off by being based in the United States, they are now a worldwide recognized brand that doesn't just trade inside the US, but all across of Europe, Asia, and Southern America. Some key stats to do with Starbucks is that they are part of the consumer industry, have a market cap at 98.3 billion, went public back in 1992, have over 400,000 current employees, have a 10-year dividend growth streak, a 5-year dividend growth rate at 7.75%, and a dividend yield that currently sits at 2.82%. Over the last 3 months, we can see from the graph they have performed pretty poorly, being down 25.68%, and in today's video we are going to see if this current price is a good entry point for Starbucks. First off, we're going to have a look at some key reasons for Starbucks stock decline. The first one being the declining sales and customer traffic. In a recent quarter, Starbucks reported a 4% drop in global same-store sales, with US sales down 3% and Chinese sales down 11%. This marks the third consecutive quarter of declining sales attributed to reduced consumer visits and a cautious consumer environment. We also have the competitive pressures and pricing challenges. Starbucks faces increased competition from more affordable coffee chains like McCafe and Tim Hortons in the US, and Luckin Coffee in China. These competitors offer lower prices, attracting price-sensitive consumers. Additionally, Starbucks' premium pricing strategy has become less effective as consumers seek better value. We then also have their operational and strategic adjustment. The company has been implementing a turnaround strategy, including simplifying menus, enhancing store ambience, and reducing reliance on automation by hiring more baristas. While these changes aim to improve customer experience, they have led to increased operational costs and have yet to yield significant improvements in sales. We also have the macroeconomic factors in consumer behavior. Economic uncertainties such as inflation and higher interest rates have led to consumers to cut back on discretionary spending, including premium coffee purchases. This shift in consumer behavior has negatively impacted Starbucks sales and profitability. And finally, Starbucks is dealing with ongoing labor disputes, including unionization efforts at numerous stores. These issues have led to strikes and legal challenges, potentially affecting store operations and public perception. All of these factors combined have contributed to investor concerns about Starbucks' short-term performance, leading to the stock price decline. Now we're going to have a look at why you should consider Starbucks, with the first one being the strong brand equity and loyal customer base. Starbucks has cultivated a globally recognized brand simultaneous with quality coffee and a premium customer experience. Its extensive network of stores and a robust loyalty program contributes to a dedicated customer base, providing a competitive edge in the coffee industry. We also have their attractive valuation. With the stock now trading approximately 30% below its 52-week high, it presents a potential value opportunity for long-term investors. With a forward PE ratio of around 21.1, Starbucks is priced more attractively compared to its historical averages, suggesting room for appreciation as the company executes its turnaround strategy. Under the new leadership of CEO Brian Niccol, Starbucks is implementing strategic changes aimed at revitalizing growth. These include simplifying operations, enhancing the customer experience, and investing in employee training and development. Such initiatives are designed to improve efficiency and drive long-term profitability. And we also can't ignore Starbucks' consistent dividend payouts. Starbucks offers a dividend yield of approximately 2.1%, higher than the S&P 500 average. The company has a history of increasing its dividend payouts, reflecting a commitment to returning value to shareholders. This consistent income stream can be appealing to investors seeking both growth and income, and that is something that I do fall into. And we finally have their growth potential in emerging markets. While facing challenges in certain markets, Starbucks continues to see growth opportunities, particularly in emerging economies. Expanding its presence in these regions can contribute to revenue diversification and long-term growth. Investors with a long-term perspective may find the current stock price an attractive entry point. Next up, we're going to have a look at their fundamental analysis and earnings call. In their most recent earnings call in Q2 2025, Starbucks reported $8.8 billion in revenue, up 3% in constant currency, despite a 1% decline in comparable store sales. Looking ahead, management is optimistic about growth, emphasizing investments in labor and marketing while targeting double store growth in the future. Now we're going to have a look at Starbucks fundamental analysis, starting off with their positive net income at around $3.1 billion. They also have positive gross profit at $9.1 billion, positive operating income at $4.4 billion, positive 3-year revenue growth at 5%, low debt to equity at negative 1.75, solid long-term solvency, but they do just have an average Altman Z-score at 2.72, average interest coverage at 7.47, they have poor short-term solvency, and positive net debt that currently sits at $10.3 billion. Next up, we're having a look at Starbucks' free cash flow. This is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on the direction a company may be heading. We can see that in 2018 to 2019, Starbucks' free cash flow peaked at just over $10 billion. The substantial rise in 2018's FCF is attributed to proceeds from the sales of the company's packaged coffee business to Nestle. Then in 2020, the sharp decrease reflects the impact of COVID-19 pandemic on global operations. More recently, while there was a recovery in 2021, subsequent years have seen fluctuations due to varying operational challenges and strategic investments. So overall, Starbucks' FCF history indicates some areas of inconsistency, but they do have the ability to generate substantial cash flow when needed. With this, I'd hope that moving forward we can see a consistent rise in FCF, and if this isn't the case, then that would strike me as a major red flag. So something that I think is very important to keep an eye on. Now we're going to have a look at their dividend history chart. As I am a dividend growth focused investor, one of the main things I'm looking for within a company is for it to be showing consistent dividend growth. One way to see this is by looking at the company's payouts throughout the year to see if it has been raising that dividend payment on a year-to-year basis. As we can see on the chart, Starbucks has demonstrated consistent growth over the past 10 years at a very healthy rate with an average rate of over 9% growth. Not only this, but due to the recent dip in price, the yield is sitting close to 3% right now, which is the highest it's ever been, making the stock look even more attractive. This is something that if you are also a dividend-focused investor, I'd recommend you looked into for any stock that you are researching. Next up, we're going to have a look at Starbucks' intrinsic value. On the worst case scenario, they were valued at $60.66 when plugging in my numbers. On the average case, being valued at $80.90, which is a 6% overvaluation on that current price. And on the best case scenario when plugging in my numbers, they were valued at $102.29, which was actually a 16% undervaluation on that current price. Next up, we're going to have a look at Starbucks Wall Street estimates, and I really like to add these in my valuations because these numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes with what they believe is an accurate valuation. We can see on their lowest forecast, they believe Starbucks would be worth $73.73, which is a 14% downside on the current price. On the average forecast, they believe it would be worth $93.35, which is a 9% upside on the current price. And on the highest forecast, they believe that Starbucks over the next 12 months could be worth $131.25, which would be a 53% upside on the current price. Now that I've got all of my results, we can add them all together to come up with our best, average, and worst case scenarios to see if Starbucks is trading at an attractive price. On the worst case, we can see that Starbucks was valued at $67.20. So with a 10% margin of safety on this price, you'd be looking to buy Starbucks at $60.48. And with a 20% margin of safety on the worst case price, you'd be looking to buy Starbucks at $53.76. On the average case being worth $87.13. So with a 10% margin of safety on the average case price, you'd be looking to buy Starbucks at $78.42. And with a 20% margin of safety on the average case price, you'd be looking to buy Starbucks at $69.71. And on the best case scenario, being valued at $116.77. So with a 10% margin of safety on this price, you'd be looking to buy Starbucks at $105.09. And with a 20% margin of safety on the best case price, you'd be looking to buy Starbucks at $93.41. So from this, we can see that their current trading price at $86.07 is only just below that average case scenario. So unfortunately, once we put that even just 10% margin of safety on the average case, they are slightly overvalued when comparing to that. So what does this mean for Starbucks? Is the stock a buy right now? Well, Starbucks remains a fundamentally strong company with a powerful global brand, loyal customer base, and consistent revenue growth. Its commitment to returning capital to shareholders through dividends is commendable, and it has a long history of increasing payouts. However, from a dividend investor perspective, the stock currently appears a bit overpriced. With a free cash flow payout ratio nearly 100% and a dividend yield below many income-focused alternatives, the margin for sustainable dividend growth is limited unless cash flow improves. In short, Starbucks is a great company, but at current valuations, it may not offer the best risk-to-reward profile for dividend-focused investors right now, but that's not to say it won't be if the price was to drop further. So that is why I think Starbucks is a great company, just not at a great price. If you found this video helpful, don't forget to like the video, subscribe for more investing insights, and drop a comment below with your thoughts on Starbucks or any stocks you're watching this month. Thanks for tuning in. Until next time, keep compounding and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.